In trading, bottom implies a crash, but this reliable bottoming formation routinely appears during massive uptrends. As a stock rockets higher, sellers take control, driving prices lower. Eventually, forces hit equilibrium, creating a slow-motion curve as buyers steadily regain dominance. Day traders using daily charts almost always miss rounding bottoms. Spotting this overarching bull shape requires a weekly scale. Beneath the price action, valid patterns feature a distinct U-shaped volume curve, reflecting the slow shift in market momentum. The broader context dictates how this pattern behaves. If it stops a long downtrend, it acts as a standard reversal. But when it forms during an existing climb, it operates as a continuation pattern, launching the stock higher. This chart shows what happens when the bull completes its right side. As the price climbs back to the old highs on the left, sellers often step back in. This resistance forms a temporary dip, known as a handle. The formation is not a valid trade until it clears that final hurdle. The strict trigger requires waiting for the price to definitively close above the highest point of the right saucer lip, or above the high of the handle. Once the breakout is confirmed, we calculate an exact profit target using the measure rule. First, identify the formation's overall height by subtracting the lowest price at the bottom of the bull from the price at the right lip. Next, add that calculated height directly to the breakout price at the right lip. This establishes a precise, mathematically backed target for the upcoming move. Statistical analysis of over 260 bull market formations shows an average rise of 43%. Using these predefined calculation steps gives a trader an objective roadmap to follow while the price action develops. Let's test this. Pause the video. Look at this stock's lowest low and the value at the right lip. Calculate the exact target price and determine where the entry trigger line belongs. The entry line sits precisely at the right lip's high. We find our height, add it to the breakout level, and project our target directly above. This chart illustrates the primary reason these setups fail: overhead resistance. Even with a perfectly shaped bull, historical price ceilings from months prior can completely suffocate upward momentum. If a stock breaks above the rim but falters before achieving even a 5% gain, it has likely hit one of these invisible walls. This creates a busted pattern, which routinely triggers a severe decline averaging over 30%. Identifying the bull shape is only the first step. Mapping historical resistance zones determines the real risk, as ignoring these ceilings is often the difference between a minor gain and a 30% loss. This chart demonstrates a common pattern failure, known as a throwback. A stock executes a perfect breakout, only to immediately reverse course and drop back to the breakout line. During this dip, traders using overly tight percentage-based stop losses get scared out of the position. They sell right at the bottom of a completely normal short-term retrace. Enduring the throwback by placing structural stop losses discipline. For this specific stock, that patience was rewarded with a massive, uninterrupted climb of 300%. To trade this formation effectively, follow these 5 rules. Stick to the weekly chart scale. Look for continuations in a bull market. Wait for a close above the right lip. Map all overhead resistance, and always calculate your targets with the measure rule. No chart pattern guarantees profit. Past performance is not indicative of future results, and strict risk management is required for all trading. Mastering the rounding bottom requires looking past the daily noise. By decoding the slow shift from selling pressure to buying demand, you can wait out the market and strike precisely when the probabilities tilt in your favor.